Welcome to Breaking News to Trading Moves.
Today, we're going to look at a recent development in the industrial sector.
Right, and our focus is really on the market influence and some of the trends that this news exposes. We're talking about cooling technology and where infrastructure spending is actually headed.
And the catalyst for all this is an upgrade for Trane Technologies, that's ticker TT, which was moved to a buy rating from Bank of America.
So we're going to look beyond just that headline. We want to explore what's really driving that optimism.
Exactly, because it points directly toward the build-out of, new high-density infrastructure all over the world.
And we structured this for you. We're going to sort of categorize the companies that are set to benefit. We're calling them our winners, and then those facing some headwinds.
Our losers, yeah. And this is all based on the current market climate and a thematic rotation that we're seeing play out.
So this really isn't about just one stock. It's about trying to understand the flow of capital in the industrial economy right now.
That's it. If you look across the industrial landscape, you can see a clear split. Some companies are catching these, strong tailwinds from tech and decarbonization,
While others are kind of struggling with higher rates and just a general economic slowdown.
we want you to see exactly where that divide is.
Okay, so let's start with the immediate reason for all this optimism around Trane. It's their deep connection to data centers, right?
It is. When you think about the growth of AI, it's not just a software issue anymore.
It's a heat problem, a very real physical heat management problem.
That is the core of the thesis. AI computation, it just uses so much more power, and it generates so much more heat than traditional cloud computing.
And the old way of doing things, air cooling, just isn't cutting it.
No, it's hitting a physical ceiling. And the analysis highlights some very specific, tangible initiatives that show Trane is positioned ahead of this curve.
Okay, let's talk about those. What are the proof points showing that they're really the go-to provider here?
So first, the analysis points to their work on NVIDIA-linked AI factory thermal management designs.
Reference design. So what does that actually mean?
It means Trane is working directly with the leading AI chip maker to define how these huge, hyperdense computing facilities have to be cooled.
So they're an essential partner from the blueprint stage onward.
Exactly. And that creates a strong barrier to entry for any of their competitors.
Being part of the blueprint from day one, that's a huge advantage. It means their systems are baked in from the very beginning. But it's not just about these massive new builds, is it? The efficiency part seems just as important.
Oh, absolutely. Managing power consumption is driving every CFO's decisions right now.
I can imagine.
The documents also mention an Amazon grocery efficiency pilot. Trane's systems are using BrainBox AI to optimize refrigeration performance there.
So that shows their solutions work across different verticals and can offer immediate cost savings on the operations side.
Yes, and the final piece, which really speaks to their tech advantage, is that recent acquisition of Stellar Energy Digital.
What does that deal represent?
That was a very strategic move. Stellar Energy Digital provides what are called turnkey liquid-to-chip cooling solutions.
Okay, so break that down for us. Liquid-to-chip cooling.
So think of it this way. Traditional air cooling is like trying to cool a steaming engine with just a fan.
Right.
Liquid-to-chip cooling, on the other hand, involves running a specialized fluid directly over the hottest parts, the chips themselves. It just pulls away so much more heat.
So if a data center wants to pack 3 or 4 times the computing power into the same physical space, which is what AI demands,
They have to move to liquid cooling. There's no other way.
this acquisition takes Trane from being a general HVAC supplier to a specialty high-margin thermal infrastructure provider.
That's exactly right. They bought the critical capability needed for the absolute highest density racks. That specialization is the key driver of the upgrade.
So if Trane is a winner because of this, who else benefits? This brings us to our first category of thematic winners, the picks and shovels for this whole digital build-out.
The specialized cooling and thermal management providers, yeah.
And the rationale is just the physics of it all.
It is. AI compute growth means rack densities are climbing, and that requires complex, precise cooling. So we're looking for companies that offer that essential high-spec equipment.
The physical gear that makes the AI boon possible. Who are the immediate beneficiaries here?
Well, beyond Trane Technologies, ticker TT, who we've been discussing, the analysis names Vertiv Holdings,
That's VRT.
VRT, and Modine Manufacturing, ticker MOD.
And how do they fit in?
Vertiv is what you'd call a pure-play data center infrastructure provider. They are completely focused on power and thermal management.
Okay, and Modine.
Modine is they're leveraging their expertise in industrial heat exchange systems and
Yeah.
applying it to these new high-density cooling needs. These three are the core plays.
Now, the Trane story isn't just about AI. There's a second tailwind on the commercial side of the HVAC market.
Right, and that stability is a necessary buffer. This is our sub-theme A, commercial HVAC and service mix.
So these are the large-scale custom projects for big buildings.
Yes, projects for places like hospitals or universities, and they generate strong, recurring service revenue. This business model is vital because it acts as a kind of financial shock absorber.
It helps stabilize performance, even if the general economy hits a rough patch.
Exactly. That stable cash flow is essential when you're investing heavily in a high-growth area like liquid cooling.
And what specific verticals are fueling that reliable demand?
It's generally non-cyclical sectors, data centers, of course, but also healthcare, education, and government facilities.
These are your long-term sticky customers?
They are. They have mandatory replacement cycles, fixed budgets. They're just less sensitive to consumer confidence or economic swings.
So who's positioned well here?
We see Trane again, ticker TT.
Uh-huh.
Also Johnson Controls, JCI, and Carrier Global, that's CARR. They all have strong commercial portfolios and huge installation footprints.
So that stable foundation then allows for our next winner sub-theme, building energy efficiency software.
Right, because if you manage one of these massive complexes, a hospital, a data center optimization isn't a luxury anymore. It's a mandate.
Precisely. The adoption of AI-driven optimization software is accelerating, and it's because of two powerful pressures.
The first is just the proven ability to generate immediate, tangible energy savings.
And the second is the global push for decarbonization.
Yep. In a lot of places, facility owners are simply being forced to become more efficient to meet regulations.
So efficiency software becomes the non-discretionary expense, right?
Okay.
It's not optional capital spending. It's a tool to reduce operating costs or just to stay compliant.
That's it. The software uses AI to intelligently control the HVAC, the lighting, power distribution. It optimizes the entire building's performance in real time.
And that moves these industrial companies into the software space, which usually comes with higher margins.
It does.
So which companies are providing that essential control layer?
Honeywell, ticker HON, is named prominently. They have extensive controls and building management systems. Johnson Controls, JCI, is another leader here, leveraging decades of experience. And no surprise, Trane Technologies, TT, shows up again. It just shows their breadth across all these areas.
That paints a clear picture of what's driving investment toward companies like Trane. But the market is splitting. So now we have to pivot and talk about the companies facing pressure.
Yes, the losers. We have to acknowledge that not everyone benefits from these AI tailwinds. Category A here is defined by residential exposure.
And this is where market conditions really start to bite.
They do. If residential demand softens, which it is, tied to housing sensitivity and higher financing costs, companies tied to home building and repair start to feel that pressure.
So their customer base is the average consumer and the housing cycle, which is slowing, not the high-end institutional build-out that's helping Trane.
That is the crucial distinction. Even while commercial demand is robust, names with a heavier residential mix can really feel the pain.
Who fits into this category?
This includes Lennox International, ticker LII, which has a larger residential component, and the distributor Watsco, ticker WSO. Their performance is really tied to home construction and renovation volume.
Okay, moving on. Category B involves rate-sensitive construction cyclicals. These are the companies that form the physical foundation of construction.
But they're also highly exposed to the cost of money. The market sees construction aggregates and materials as very sensitive to commercial activity and financing conditions.
So when the cost of capital is high, big projects get delayed or canceled.
And these companies are the first to feel it. If a developer holds off on breaking ground because the interest rate makes the project unprofitable,
The materials suppliers take the immediate hit.
exactly. Their valuations and their volumes compress when construction slows down. We're looking at essential building blocks here. Vulcan Materials, VMC, and Martin Marietta Materials, MLM.
And these are often seen as gauges for broad construction activity.
They are. And that activity is directly impacted by how expensive it is to borrow for big projects.
Finally, we turn to Category C, the premium multiple industrial compounders. Now, these are often high-quality businesses, but they face a specific challenge.
Yeah, this one is more about trading dynamics and investor expectations. It's a risk tied to market mechanics.
How so?
These companies typically trade at a very high valuation, a high price to earnings, or PE multiple, because investors expect steady, predictable growth far into the future.
So what happens if the market gets less optimistic, or if safer alternatives like bonds become more attractive?
Well, that's when the risk shows up. When investors get more cautious, they're suddenly less willing to pay such a high premium for growth that's years away.
And their valuation, their multiple, it contracts quickly.
Right. The underlying business might still be perfectly healthy, but the stock price underperforms because of this multiple compression.
So the valuation risk is higher than the fundamental business risk. Who fits that description?
We're looking at names like Parker Hannifin, that's PH, a diversified industrial giant, and Rockwell Automation, ROK, known for its industrial automation and software. Excellent businesses, but those high PE ratios leave them vulnerable.
This has really provided a comprehensive view of how capital is moving in the industrial sector. For you, the ultimate takeaway here is the existence of two powerful opposing forces.
Right. On one side, you have these strong tailwinds from AI and decarbonization spending. On the other, you have this counter-cyclical pressure on housing and these highly valued industrial stocks.
So what this market analysis really exposes is that budgets aren't shrinking, they're just being reorganized.
That's a great way to put it. You should reflect on how this combination of technology, AI optimization, liquid cooling, and long-term targets like decarbonization is actively restructuring budget priorities.
That combination forces spending into specialized areas.
And that creates lasting demand that will likely persist far beyond the current interest rate cycle.
Thank you for joining us for this analysis of the market landscape.
And please remember, this discussion is not financial advice or a recommendation to buy or sell any asset. This is purely the opinion of the author.